Hi, this is Praneeth again with marginal costing session 2. Here is an example where we have January, February sales and less variable cost of goods sold $35 and the amounts product contribution margins less variable selling overheads total contribution margin less fixed expenses fixed factory overheads fixed selling overheads net profit. Here is a worknote 1 where standard fixed overheads rate equal to budgeted total fixed factory overheads budgeted number of unit produced equal to the amounts by 1000 units and equal to $30 units. Worknote 2 production cost per unit under absorption costing direct materials 20 direct labor 10 fixed factory overhead absorbs 30 variable factory overheads 5 65 and worknote 3 under over absorption of fixed factory overheads January, February and March. Fixed overheads the amounts are 30,000, 39,000, 27,000. Fixed overheads incurred 30,000, 30,000, 30,000 and there is a worknote of for also variable production cost per unit under marginal costing direct materials 20 direct labor 10 variable factory overhead 5. Here is a difference between cost and absorption costing and marginal costing. Here is a table regarding differences of absorption costing and marginal costing. Treatment for fixed manufacturing overheads. Absorption costing is fixed manufacturing overheads are treated as product costing. It is believed that products cannot be produced without the resources provided by fixed manufacturing overheads. Marginal costing. Fixed manufacturing overheads are treated as period costs. It is believed that only the variable costs are relevant to decision making. Fixed manufacturing overheads will be incurred regardless. Value of costing stock. Absorption costing. In absorption costing, high value of closing stock will be obtained as some factory overheads are included as product cost and carried forward as closing stock. In the marginal cost, lower value of closing stock that include the variable cost only. Coming to the reported profit in the absorption costing and the marginal costing. If the production sales account profit is equal to MC profit. If production sales account profit MC profit as sum of factory overhead will be deferred as product cost under the absorption costing. If production is less than sales, account profit will be more than MC profit as the previously deferred factory overhead will be released and charged as cost of goods sold. Argument for absorption costing. Compliance with the generally accepted accounting principles, importance of fixed overheads for production, avoidance of fictions, profit or loss. During the period of high sales, the production is small than the sales. A smaller number of fixed manufacturing overheads are charged. A higher net profit will be obtained under marginal costing. Absorption costing is better in avoiding the fluctuations of profit being reported in marginal costing. Arguments for marginal costing. More relevances to decision making, avoidance of profit manipulation. Marginal costing can avoid profit manipulation by adjusting the stock level. Consideration given to fixed cost. In fact, marginal costing does not ignore fixed cost in setting the selling price. On the contrary, is provided useful information for break-even analysis that indicates whether fixed costs can be converted with the charge in sales volumes. Break-even analysis definition. Break-even analysis is also known as cost value profit analysis. Break-even analysis is the study of the relationship between selling prices, sales volumes, fixed costs, variable costs, and profit at various levels of activity. Application. Break-even analysis can be used to determine a company's break-even point (BEP), which is called. Break-even point is a level of activity at which the total revenue is equal to total cost. At this level, the company makes no profit. Assumption of break-even point analysis. Prevalent range. The prevalent range is the range of an activity over which the fixed cost will remain fixed in total and the variable cost per unit will remain constant. Fixed cost. The total fixed costs are assumed to be constant in total. Variable cost. The variable cost will increase with the increasing number of units produced. Sales revenue. The total revenue will increase with the increasing number of units produced. Coming to the cost, there are types of costs which are total cost, variable cost, fixed cost, which are equal to sales per units. Here is a profit where sales revenue and total are graphically used. Calculation of methods. Calculation methods. There are four calculation methods which are break-even point, target point, margin of safety, changes in components of break-even analysis. Break-even point. Calculation method. Contribution is defined as the excess of sales revenue over the variable cost. The total contribution is equal to total fixed cost. Here is a formula. Break-even point is equal to fixed cost by contribution per unit. Sales revenue at break-even point equal to break-even point hashtag selling price. Alternative method is also available, which is sales revenue at break-even point equal to contribution required to break-even, contribution to sales ratio. Break-even point in units. Sales revenue at break-even point by selling price. Examples. Selling price per unit will be $12. Variable cost per unit $3. Fixed cost is $45,000. Required compute the break-even point. Break-even point in units is equal to fixed cost contribution per unit equal to the it is explanation where this problem is solved. Okay, we have an alternative method. Contribution to sales ratio $9 by $12 equal to 100% is equal to 75% sales revenue at break-even point is equal to contribution required to break-even contribution to sales ratio is equal to $45,000 by 75% is equal to $60,000. Break-even point in units is equal to $60,000 by $12 is equal to 5,000 units. Target point. Formula. Number of units at target point is equal to fixed cost plus target points by contribution per unit. Required sales revenue fixed cost plus target profit by contributing to sales ratio. Example, selling price per unit will be $12, variable cost per unit $3, fixed cost $45,000, target price profit $18,000. Required compute the sales volume required to achieve the target profit. Here is a formula for computation of the sales value required here. Number of units as the target point is applied by the formula fixed cost plus target profit contribution per unit, which is a answer will be $84,000. We have an alternate method also, which is required sales revenue fixed cost plus target cost by contribution to sales ratio, which is equal to 45,000 plus $18,000 by 75% is equal to $84,000. Units sold at target profit is equal to 84,000 by $12, which is equal to 7,000 units. This is the end of the session 2. We'll be back in session 3.